Mr. Jim Welsh of Macro Tides. Good to see you, my friend.
Likewise, Blake. What do you
So,
think?
hey, we're at new all-time highs. What do you make of
Yeah.
this craziness that we've got going on?
Well, my take has been for really a number of weeks that we were forming a triangle. My belief is that that is a wave four from the lows we saw in on July 29th, I think it is, and that we were going to get a thrust higher. And 7,700 to 7,800 was, like a guesstimate. And then you have to see how it unfolds. And this last week in the weekly technical review on Monday, my expectation was we were going to see the S&P move above the high we saw a handful of days ago at 77.93. But my take is that this is the end. Oh my God. Tune the doors up, the end.
This
Um,
is it, huh? Like it's
Yeah,
not no
this is
more.
wave five, and potentially it's five waves up from the March 30th low. So the S&P's gone from, call it 6,300 to 7,800, just to make nice round numbers, 1,500 points. What's a 382 retracement of that? About 550 points or so. So I think we're on the doorstep of a 4 to 7% correction over the next, 1 to 2 months or so.
Okay, so I was just talking about the pennant that we've developed in the S&P. And I'm just looking up at my chart over here on the Nasdaq 100. We're nearing highs. Russell 2000s breaking out to new all-time highs. Is it possible that the S, because it's such low volume? We were just talking about how rate expectations have dropped, and rate expectations have dropped to where people now believe that the Fed's not going to raise rates, due to the CPI and the PPI that came out today. And how about if retail sales come in weak tomorrow? Is it possible that the S&P reaches for 8,000 before it's all said and done?
Of course, it's possible. It is. I mean, the one thing I'm sorry I didn't include it in the chart deck for today, but in Monday's weekly technical review, what I went through, and I think you and I may have talked about this, that if you look at the number of stocks that go up as a ratio to how many stocks go down, and you compare the last 2 weeks to what happened off the March 30th low, it is so much weaker, Blake. So in terms of the S&P's made a great move. It looks like a vertical shot, which was expected.
Right,
But
right.
under the surface, this ratio of breadth has been really, really weak. And the analogy I use is if you throw a ball up at 50 miles an hour, yeah, it's going to continue to gain altitude for a window of time before rolling
Yeah.
over and coming down. You throw it at 100 miles an hour, obviously the latent energy is going to last longer and carry it higher. Well, this rally, based on that indicator, is the 50-mile an hour toss. So when I look at this and the structure of the chart, my conclusion is in probability land that we're nearing a high and we're set up for a pullback. And then it's just going to come down to, is it a garden variety, or do we get some reasons to sell that causes the 7% correction or not? So
Yeah, and Jim, that's a great point, actually. We have one of our YouTube listeners, obviously Asian because I can't. Yeah, I can't read that. Zix. So Zix, just one. I'm going to read this question. Says, or you're all in a YouTube disaster scenario echo chamber feedback loop. Um, so I think it was earlier when Chris is like, "Oh, you're going to be you see a 50% correction."
yeah, yeah, yeah.
Um, look, Zix. Let me just say, first of all, no, I mean, we've been focused on the stock market just rallying. The fact of the matter is, though, we are in a situation that maybe some of you have never seen before. Like I said, I'm in my 50s. I turned 54 in a week and a half. Jim is like 170 and he turns 172. Just kidding, Jim.
I
But
know.
Jim has
I
been
don't go
around.
up by 1 year anymore. I go up by 2 years to the credit. And I
Jim's been
wasn't
around
born
long.
on leap year on February
Jim's been
20.
around. Jim's been around longer than me, but we've been trading for decades, and I've
Yeah.
seen the song and dance before. The question is, how far do we go? And that's why I still think that 8,000 is possible, just because technically it looks possible. But I may be wrong, and maybe 6 months from now we look back, Jim, and we're like, wow, what's 200? What's 200 spooze points amongst friends? When
Yeah,
when
yeah,
a
yeah,
when a
yeah.
top
Yeah.
actually comes in. The
No,
thing
until
is,
you,
we
yeah.
are we are dealing in an unprecedented times with a lot of build out that reminds me and echoes a lot of the dot-com bubble, which I did trade through.
Mhm.
And by the way, I benefited greatly through. That was what really kickstarted my career, when I was in my mid 20s, and I was 27, 28 years old. It was like, how I made all my money was through the dot-com,
Yeah.
trading through the dot-com bubble and then shorting the top. And so this is, since I've seen this song and dance before, and I know you have too, Jim, we don't talk in a doom loop. We look at the markets pretty constructively, and I could say that, hey, everything looks bullish right now, just as I've said for the last 30 minutes. But we have to know where things get a little dicey. And right now, like the price action in Cisco overnight, that's dicey. That's the kind of stuff that you don't want to see when the markets are rallying. But
Right.
Jim, I'm going to shut myself up. I want to let you respond to
The one
Zig's
thing I
and
think,
then go into your
yeah,
charts.
okay, is time frames. I agree with Chris. There's a secular bear market that's going to happen. We've had like three or four of them going back the last 120 years. So it's not like we're talking about something that's never happened before. The most recent one was from 2000 to 2009. The S&P fell not once, but twice, 50%, 57%. And then 66 to 82, 16 years of chopping around, and it included a 50% plus decline. So these things happen, and the symptoms are people are really excited at these big,
Yeah.
big clubs. They're very, very invested. So household investment in terms of the stock market is the highest it's ever been. All right. And the reason it gets that way is because there's a good story that tells everybody you got to be in. Well, guess what? At some point in time, the story changes. And the reality is most people don't see the change coming. And so from a time frame standpoint, is there a secular bear market coming? Yes. Is it starting this week or next week? I don't think so. And so the time frame I'm talking about is okay, the next, let's say 1 to 3 months. And I think to address the comment you're making, Blake, is could we see a 4 to 7% correction and then the move above 8,000? That would be my bet. So we get a pullback and then we have the opportunity for another thrust that takes the market higher.
Jim, I remember, I want to say after the financial crisis, the GFC, it was 2008, 2007, I guess, seven and a half, 2008, when the S&P had lost 80% of its value. And I remember going
Well, that would
outside
be
of my office.
The NASDAQ lost 80%.
Yeah. But my retirement account, and I don't want to actually use the actual numbers,
Yeah.
but I remember going outside of my office in Plano, Texas, and we'd been acquired by the Wise Trade Group at that point in time, and it was I just started a chat room, like I just started our chat room that's in our current form,
Right,
trading
right, right.
analytics, like in 2005. So I remember we were 2 years into this, and I remember going outside. It was brisk. It was like kind of chilly outside.
Yeah, yeah, yeah.
And I remember, because I get up really early in the morning being a currency guy. I remember being at like 6 o'clock in the morning. It was like 6 or 6:30. Sun was just coming up, very desolate outside of our office. I was looking around, but bunch of, it's the typically like our offices would be empty, like,
Yeah.
parking lot wise. I remember looking around and it was like a sunny day and the S&P was trading probably around 690 or something. It was a couple of
Yeah.
days from the bottom, like
Right.
literally a couple of days from
March of 2009.
yeah, okay, is it 2009 from the Haynes bottom? And I remember walking outside, I lit a cigarette, and I was like, the world's gonna come to an end. soon. I remember vividly saying that.
Yeah.
And then I went inside, slapped myself in the face. I'm like, dude, I actually just put everything I had into my retirement account at that moment. That is actually what I did. And then I rode the S&P up to 1100 and I thought I was king shit. And
Yeah. Well, that's a
yeah.
good trade. Yeah.
Anyway, regardless, I remember that feeling so
Yeah.
vividly.
Right.
And it's scary. It's not fun.
Well, here's my little
Yeah.
story. There's a financial advisor who has been a subscriber of mine since about 2010. And what he's told me is he spent 150 hours after the financial crisis looking for people who both called the top in 2007, the decline, but then turned bullish in 2009. He found three people: Jeff Gunlock, Ned Davis, which is a
Mhm.
big research firm,
Of course.
and Jim Welch. And
Who?
so Jim Welch. So
Never heard of
there were signs before that decline took place. And there will be signs when we make this very significant top and start to roll over. There will be signs. I just don't see that they're here yet. But
Yeah.
I'm at the same time, I'm cognizant that I'm going to be looking for those signs because it's going to be really important. And historically, everyone is the sky is falling at the bottom, and we're going to the moon, Alice, at the top. And contrary opinion, which is kind of what you're referencing, Blake, is way more important than if you listen to CNBC and I'm sure Bloomberg, they talk about the market discounts the future. Okay. And in October 2007, the S&P made a new all-time high. What was this discounting? In March of 2009, your personal experience. The S&P has been going down. It's down over 56%. Oh my God. What was it discounting? The end of the world? So my point is the concept that markets discount the future, that's right about 60% of the time when you're in the middle of moves. The economy's in decent shape, earnings are growing. Conversely, gee, things are unraveling, it's getting worse. But at important tops and bottoms, the idea of the market discounting the future is always wrong. And yet it's gospel on places like CNBC and I'm sure Bloomberg, as opposed to contrary opinion.
Yeah.
So,
It is. And by the way, bear markets don't sell, just so you guys know. They don't. They sell
no,
for people that are selling their newsletter or whatever. That's
right.
just you guys are here. Bears will they just I
Yeah,
mean
yeah,
you can see them on the YouTube doom loops.
yeah.
They're selling their subscriptions all along because they just talk and bears always have a great story and they have a great story. But you look at the markets critically through the lens of the charts and you take into account everything all the information we have. And when things change, you have to be good enough to recognize when those changes come. And Jim, I
Right.
think you are one of those three people. By the way, your last name is Welsh, right?
It still is.
All right. All right. Well, Jim, let's get into some of these
Okay.
charts really quick because maybe you might
Yeah,
get us into.
we'll go quickly because I've got a lot of charts, but
Yeah. I mean, you got a
basic
lot of charts
stuff.
and we did a lot of talking. So,
Yeah, we
um,
did.
all right.
Okay. So again, we try to combine fundamental analysis and technical analysis because to me, at important turning points, you need that cohesion where they're both kind of providing the same message. That was the case in 2007. In December of 2007, Blake, I was saying there's going to be a recession in 2008. Housing prices are going to drop by 20%. People thought I was nuts. Okay. So I just wanted to provide perspective. The unemployment, the jobs report was soft. I think people have gone a little too far in terms of, oh my God, the labor market's going to hell. This is perspective. If you go back to 1948, the average unemployment rate through both good times and bad is 5.7%. So if you want to know, hey, do we have slack in the economy or is it tight? I just basically said, let's do a band. What's 20% above 5.7? What's 20% below 5.7? You get 456. The unemployment rate this last month was 4.1. So if you're sitting on the Fed, are you going to believe that the labor market is tight? And the answer is yes. And
Yeah.
so to me, this was just to provide perspective. Plus, over the last, 6, 8 months, it's declined from 4.5 to 4.1. So even the near-term trend, and we can debate about the participation rate and the impact of immigration that's been happening in terms of, removing bodies from the labor market and so forth. But just from a historical perspective, this just shows us that, you know what, overall, the labor market is tight. And it also explains why the economy continues to be okay. There's people, I did an interview and, the comments were like, oh my God, this guy's an idiot. The economy is shit and all that. And the point I try to make is that for the bottom 20 or 30% of wage earners, it is hard because their wages haven't kept up with the cost of living. But the top 10% represent almost 50% of spending. So the pressure on that bottom third, they represent maybe 10% of consumer spending in total. So yeah, is it tough? Absolutely. But do they make or break the economy? No. And I think that's one of the things that has kind of colored people's vision about the economy, Blake, is if you're in that or people are in that bottom 30% struggling, that in a sense creates your whole worldview. And all I'm
Yeah.
trying to say is you got to look at it from a top-down perspective of why the economy is still doing okay, and the low unemployment rate is one of those reasons.
Now you talk about jobs needed here.
Yes.
So what is this chart representing to you?
Okay. Well, on the left-hand side, we can see 3 month job growth. The last 3 months, including the 23,000 decline we saw for July, is about 20,000. All right. And clearly, the number, if you look at the last 4 or 5 bars, has it been softening? Yes. All right. That 30,000 needed. What the Fed has estimated, and other private economists as well, Blake, is we're at that kind of a weird place that we almost have never been before in history. The number of people wanting to enter the labor market is very low. Therefore, you don't have to create a lot of jobs to allow the people who want to get a job to enter. And that number is around 30,000. For decades, it was probably 150,000 or more because you had so many people, people had babies 18 years later. Hey, I want to get a job. 22 years later, I want to get a job. Well, that has changed dramatically. I mean, since 2007, the birth rate is, I don't want to say collapsed, it's down significantly. So my point is, mentally, we're all been conditioned that, boy, you better have 100,000 jobs or more to reflect a healthy labor market. And this is like a major reset. Maybe you only need 30,000 jobs to kind of have the labor market in balance. Through that lens, the 20,000 average the last 3 months does not look dire. It doesn't look like the labor market's falling apart. The right-hand side shows revisions. And you can see how revisions have shaved off. I think in the last 2 months was about 100,000 jobs. So we're seeing a softening in the labor market. I just think potentially people, um, you know, overreacted to, oh my God, a loss of 23,000. Plus,
Yeah.
I'll note that there was a decline of 50,000 government jobs related to education. Now, during the summertime, that seasonal adjustment for education can get funky. And leisure dropped 40,000 jobs. So there were some data points in there, Blake, that even cast some doubt about, well, how legitimate was that minus 23,000? But from a bigger picture standpoint, is the labor market softening a little bit? Yes. Is it problematic? No, I don't believe so. And for the FOMC members who are more worried about inflation, I don't think that jobs report is going to make them think, oh my God, I got to shift and I'll worry more about the labor market. I don't think that's the case.
Right. And that's what, and Chris Pulver was just saying that that's, the 20,000, jobs per month is a break even for the labor market. And yeah, I mean, you're going to have a little bit of volatility and, some people might even chalk that up to the World Cup being over too.
In
So
terms of the ending of that's what I wrote on
yeah,
Monday. That
yeah.
that probably played a role in the 20,000 or the 40,000 decline in leisure and hospitality.
Sure. So let's talk about the CPI now, Jim,
Yep.
because CPI different situation
Yep.
that moved the needle this week. It didn't really move the needle a whole lot. We saw the dollar kind of jostle around a little bit. I think that was more
Yeah.
positioning than anything. But how are you reading the CPI?
Well, the numbers came in as expected. As I wrote Monday, my thought we'll see about a 0.2% increase. Of course, last month it was minus zero point 0.4 because of the big drop we saw in energy. I'm not sure some of the rebound that we saw during the month of August, or pardon me, July, has bled through completely, Blake, because I think gas prices were up 7% in the month of July, and crude was up, I don't know, 25% or something. But nonetheless, if you just look at the flat line of the core, in January, it was 2.5. So it went up to 2.9 in May. And when we were talking back in May, I was like, Blake, we're going to see it come down in the next few months. And we went through the discussion of why, and it has. I think you can see a little bit more softening in the next couple months as well. But from the Fed's perspective, after 63 or 4 months above 2%, are the hawks going to say, oh, okay, now I don't have to worry about inflation? I don't think so. A number of them have said, I really need to see signs that we're really working our way down to 2.5. I'm not sure this does it. And the last thing I got to say, and it's important, everyone's just, well, no, the percentage of the hike is this, and oh no, after this data, it's that. The reality is most of those people have not made up their mind. We're at a point where we're going to get another employment report, another CPI. We get a PCE report, I think, tomorrow. And I think there's enough people sitting on the fence, Blake, is that I don't have to make up my mind today. We're going to get more data, and I'm going to want to see that data. So all this jockeying in terms of will they, raise in September or not, and the percentage is jumping around, it's noise. The people who are actually going to make the decision haven't made their decision yet. So
Yeah. All right. Well, yields have been stubbornly strong, and we've seen them bounce even after the jobs report last week. They came in a little worse than expected. I think the market actually, after the knee-jerk reaction, realized, that wasn't really that bad.
right,
Although some
right.
people were making it out to be bad, as you pointed out.
Yep.
Yields bounce back, and the 10-year yield still looks pretty constructive here. What are your thoughts technically?
Well, the thought I had was that we could see the 10-year get down near 451 was the number I used last week, 455 this week. Why? Because you saw about a 15 basis point decline from 4747 to the 4603. Well, what's 15 basis points from 470, 455? So this looks like potentially you could see yields come down a bit more in the next handful of days. I continue to believe that the trend is up. One of the things is the amount of paper. In the month of July, the monthly deficit was over $400 billion. The annual deficit, according to the CBO, Congressional Budget Office, which calculates this stuff, for this year, ending in September, is 2.1 trillion. So this is, again, one of the reasons why the economy is holding up. Well, the government's running a 6% annual deficit. That's a lot of spending flowing into the economy. So I still believe the trend is up and that we're going to work our way to 5% in coming months.
All right. Well, let's take a look at gold, because gold has had a nice rally from the lows.
Yep.
Point out the triangle last week. It's continued to extend, and the pullbacks have been very minor now. So I know what you're going to say, just because I meet with you every week. But is that the low? Was that the low?
Well, over the next 12 months, I don't believe so. Again, my belief has been is that the decline from 55.95 to 39.45 was the first part of a larger wave for correction. In other words, you had this enormous move from 16.16 to 55.95 from September of 22 to January of this year. I think that to correct that move, the magnitude of it, you're going to need time and price erosion. So when we got down to the 4,000 level, and by the way, in January I was talking 4,100 that we could see, and then over the last month or so, I'm like, you know what? I think we're in the process of forming a bottom, which is why I recommended gold under 4,000, under 39.60 to be exact, in anticipation that we're going to see a B wave rally. So we had the A of four, we're in B of four, and I think potentially we're nearing the end of the first part of that B wave, which is why on Monday I suggested that Tuesday morning it was time to sell half of the gold position. So the average cost basis on the going in was 4,063, and in the first 15 minutes of trading Tuesday morning, gold fluctuated between, I think it was 43.93 and 44.03. So I picked the 44.98 as being okay, an average of where people are going to. I think we're going to see a pullback, and you could see that pullback down towards 4,200. Then my expectation, Blake, is we're going to see another leg higher that would take gold potentially up to 4,700. And
All right.
all that is a retracement of the $1,600 move we saw from 55.95 to 39.45. So to answer your question, when this B wave is over, I think gold's going below 4,000.
See, Jim, you know what it is? My week ahead video that I did last Friday, I was like, if gold dips to 4,200, I want to be long. And that was like one of my trades of the week. See, my
Yep,
head, my thinking's just ahead of yours. That's it. That's why it
it
didn't happen
is.
this week.
And I'm used to it, man. But
Oh man, no,
at least
that's great.
I'm
I think
reaffirming your guidance, right?
yes,
It's not the
yes.
worst thing in the world.
No, no, I think it's great. I'm like, I've been wanting to buy gold at 4,200 all week. It's just
Yeah. Well, and look at the
maybe it's gonna
RSI.
get there next week.
Look at the RSI. So the other one of the things I was pointing out is gold kept kind of a falling wedge. The RSI kept making higher lows. Well, now the RSI is up to 70. Well, that's why to me it's time to at least take some money off the table, and let's see how much of a pullback we get. But I'm with you. I think on this drop that I think is coming, I want to look to be a buyer and build that position back up.
All right, very good. All right, let's continue on, Jim. Let's talk about gold stocks. So GDX.
Yeah.
So
Yeah,
what are you doing here?
we don't talk about this, but every week in my weekly technical review, when I talk about gold, I talk about the gold stocks. And the
Yeah.
same story is that as GDX was making a lower low below 69, look at the bottom panel, the RSI, it was making a higher low. Same kind of a falling wedge in GDX. So, my take was, hey, it's time to buy it and then add to it above 77.99. And the reason is GDX as well as gold kept making lower highs and lower lows. That's the definition of a downtrend. Then gold got to 41.66, GDX got to 77.90, and they both had made higher lows. So taking out those prior highs broke that pattern. And so anyway, you can see that blue trend line connects the lows that have taken place over the last 6 or 9 months. So going back to that trend line is a natural level of resistance, that you're going to the underside of it. We had one day above it, I think it was yesterday. The RSI on GDX got above 70 modestly. And so again, to me, this was a place to sell half of the position, which, and I sent out a special report on Monday, an hour and 15 minutes before the close, to tell people, hey, it's time to sell half of the GDX position. And, that's the average out price is 90.43. At the same time, I'm thinking that we get a pullback here. I'm looking to go back in because I think if gold makes that move to 45 to 4,700, GDX is going to make a run to 102. And there's an outside chance it making a new all-time high. Once the gold stocks go, they go. I mean, look at in just what 3 weeks, it went from under 69 to 92,
Yeah.
$23, like,
It's a hell of a move.
35% in a
Yeah.
few weeks. So if you get something similar, you pull back to, let's say, 81, 82-ish. There's a gap, I think, at 80.18. And then you add, 30, $23, you're above the 102. So that's my longer term outlook. Just short term, I thought we're set up for a pullback.
All right, interesting. We had a Tracy Schuchart on yesterday, and she was looking for a similar type of move in gold as well. And she was talking about the miners the last couple of weeks. So very interesting that both of you are really confirming the same thing.
Yeah. Great
S&P.
minds running in a small circle.
That's right. Right. All right.
All right.
So the S&P, well, this is where you and I might differ a little bit. I still think there's some upside in the S&P. I
Yeah.
look at look at the markets here, and I see this, nice little pennant and consolidation and, breakout. I still think we got further to go, but you look like you might be, this might be it for you.
Yeah, yeah. As we talked at, the outset, from the high at 76.20, that looks like, A, B, C, D, E down to the 73.14. And if you look at a chart, this chart doesn't cover it, but going back to the March low, you can kind of see one, two, wave three ending at 76.20. Then this triangle formed, which is classic wave four behavior. And then you're supposed to get a thrust. Well, we've gotten a thrust. As I noted earlier, the breadth underneath that thrust has not been very impressive at all. And so for me, the rally from 73.14, you can see one up, two down. Wave three was the 77.93, which is why on Monday I think we're going to get another pop above 77.93 to complete this move. Now, is this wave one of a larger rally? In other words, we'll get a wave two pullback and then we're going to motor up to 8,200 or whatever the number is. That's certainly possible. But just looking at the chart pattern that I see and what led me to believe that we were going to see a rally above 76.20 was the triangle. So the next handful of days are going to be, kind of important to see, okay, is it just a very shallow pullback, holding comfortably above 76.20, pull back to 76.50 or something, and then, another leg higher? That is possible. I'm just in the camp that I think this is a place to take money off the chips. And if you want to be a wild and crazy guy, taking out a small short position is warranted. And then we'll see just what degree of weakness shows up.
Well, you bring up a really interesting chart. You're going to bring up the Mag 7, which hasn't done crap for a while. And so
Right.
that's why I'm asking, why are you going to bring up this chart? Because Mag 7,
Yeah.
I'll just say, eyeballing it, that is what we call a Gartley pattern, which it's signaling a reversal. But are you seeing it the same way? Not a Gartley necessarily. I know harmonics is anything, but
Well,
are you seeing a reversal here?
yeah, I'm showing this because I've been covering it the last couple months in my letter.
Okay.
And because Mag 7 are obviously very important. The
Yeah.
weighting in the S&P is huge relative to the other 493 stocks. And in late June, I noted you've got five waves down from the high at 71.16 or whatever that number is. So to me, what that implied was you've completed something, five waves down. It suggests that you're going to get an intervening rebound to retrace that decline, some percentage of it. But that five down then means after whatever bounce we get, there's another leg down coming. And so I was looking for it to rally from the 61 level up to 67. It got to a little over 69. And then as we were bottoming in July 29th, you can see, it bottomed. And I thought if the S&P, Blake, was going to get above 76.20 and make that move up towards 7,800, you needed the Mag 7 to rally and you needed the semiconductor stocks to rally. So this looks like an ABC up. And I think it opens the door for this to roll over and decline below 60.72. So my idea of, gee, the S&P is setting up for a pullback of some magnitude. One of the factors that supports that outlook is this chart pattern in the Mag 7 stocks. They look ripe for a deeper pullback.
Got it. All right. Well, let's take a look at the semiconductors. You talked about the stock market's going to top when semiconductors top. Now, semiconductors obviously have topped, but the stock market continues to grind out new highs. So,
Right.
how are
Well,
you seeing it here?
yeah. Well, and back in June when we were talking, I said I think the stocks semi SMH is going to drop to 527. And then as we got closer, I said, you know what? I think it'll hit that blue trend line, which was around 515. And you had a spike down just below it by a little bit. My belief was that we would see SMH, and what I wrote about a couple of weeks ago is a rally to 592. We got there today. Can it go a little bit higher? Of course it can. But same idea that we've had this pullback, things got oversold, we got an oversold bounce. I think that bounce is going to be followed by another decline where the semiconductor index will drop below the 503 low. If that happens, again, that will be supportive of a deeper pullback in the S&P. If you have both the Mag 7 and these stocks declining, just as it kind of kept the S&P from, moving up aggressively during June and July. All we did is go sideways because you had those stocks pulling us down while other sectors were moving higher. To me, these are all the little pieces that have led me to the conclusion that I think we're near, a high, at least a short-term high, and potentially a more intermediate high in the S&P.
But Jim, but couldn't we get just massive rotation and General Electric become the biggest company in the world once again?
Why
Come
not?
on.
And then Cisco will be right behind it.
Yeah, you saw Cisco's. I don't know if you were here when I was talking about it at the very beginning. We just hit the ABCD. Well, we did it a couple months ago of the whole .com sell-off. So it's like maybe Cisco is the next Nvidia. You never know, Jim. You never know. Okay, the next chart, or the second to last chart you brought, is the dollar. You've been very constructive on the dollar
since January.
Since January. I actually just saw analysis from an analyst over at one of the big FX shops. He's like, this is an inverted head and shoulder pattern. The dollar is going to rally from here. I mean, this is pretty important support, I would think.
Yeah, it is. It is for obvious reasons. When we got up to the 101.80, I thought we'd have a pullback, and the pullback has transpired. A, B, C. Well, the C wave should have 5 legs. And if we were looking at a 60-minute chart, you could see it. 1, 2, 3, 4, 5. Last week, I said, okay, if you get below 99.42, it's a buy. And it traded to 99.40. This choppy pattern that we've seen in the last, 6, 7 trading days, there could be one more dip down. Can't rule it out. I think if you get above the 100.35, that would, to me, be somewhat conclusive that the low is in and the dollar's trading above 101.80, or it's on its way to do that.
Yeah.
So, again, we've had, a shift in perception that the Fed won't hike in September. I'm not in that camp. I think there's still reasonably high, more than 50-50 that they will hike in September. And obviously, if the pendulum starts to swing back and Treasury yields start to move higher, those are tailwinds for the dollar. So, and the economy, I think the Atlanta Fed's GDP now is like above 5% for the second quarter, or pardon me, for the third quarter. Now that's a real premature number and so forth. But again, it just shows that the economy seems to be doing just fine. Thank you.
Yeah.
So,
Yeah, it does feel that way. And I would also agree that this is pretty key support. Now, you did bring a chart of crude. I don't know why, because it ain't doing anything. But if you must do analysis on crude, we're gonna gladly oblige.
You're going to indulge me. Well, thank you very much. All right.
Yes.
So I expected a rally up, and we got a little higher than I thought at the 93.50, I think it is, or whatever. I thought we'd have a pullback. The pullback is ABC. And the key level to me, Blake, was closing below 75 even. It got to 74.20 something or 74.50 intraday, but it closed
23,
at 75. Yeah, it closed at 75.23 that day, and it's been up ever since. So that 3-wave pattern to me implies that we're going to get a lift above 85.57. It also opens the door to that from the rally from 67 to 93 is the first part of a bigger move higher. So what's 26 to 74? That's 100. So I think there's a shot, again, as long as it doesn't close below 75. And if we start to see more strength, we'll be able to raise that break-even level, if you will, or make or break level. But I think oil is going to move above 85.57 and potentially above that 93.50.
Well, Jim, I think you could probably agree, and I think most of the market probably looks at it this way too, is that that it doesn't seem like there's going to be any resolution with the U.S. and Iran. I mean, the comments yesterday from President Trump was, well, I guess we're just going to, we control the Strait of Hormuz. I guess we're going to keep it. That meant to me yesterday, like he's done negotiating on this opening the strait. He could care less now,
Yeah,
based on
yeah.
that comment alone. And as you know, this tussle is going to continue, and it's probably going to continue well into the midterms and beyond. So I don't see
Well, I
why
think that
crude
that's
oil should go down.
yeah, and I think that's Iran's strategy is that we'll rope a dope, which is the analogy I've been using, that because they believe that the longer it lasts, the stalemate, and you get closer to the midterms, that Trump will cave in. It's certainly possible. They think they're winning. That's the bottom line, but they think they're winning. And in Monday's weekly technical review, I listed the 8 or 10, demands that they have, and they're ridiculous. So I think again, you have the hardliners in Iran that really, I think, are running the show, and I don't see how they're going to, give up the ship, so to speak. And so,
Yeah.
yes, I think this continues, and I think more oil is probably coming out of there than maybe we know, but at the same time, there's a huge shortage that's been developing relative to the last 4 or 5 months. And I think somewhere along the line, upward pressure on oil and things like diesel is already happening. So anyway, bottom line is the chart pattern, just as I look at it, says, you know what, near term, I think we're going to see higher prices. What causes that? We can all make guesses, but
Yeah.
that's what the chart pattern looks like.
All right. Well, Jim, I appreciate you going through these chart patterns with us and all the macro views. Guys, if you don't follow Jim, obviously he is at Jim Welsh Macro on X. But more importantly, send him an email so he can send you the most recent technical review. Jim, what is your email that they can send you?
Jim
Any
Welsh Macro at Gmail.
Jim Welsh Macro at Gmail. That's good. And make sure you let him know that you saw him here on the Trading Analytics Show, Lunch Money, Traders Summit, wherever you saw Jim. Let him know, because if you decide to stick around, he'll say you're a friend and give you a healthy discount. So
That is correct.
all
So,
right. Well, Jim, appreciate you being here as always. I love you just keeping us all on track. We're bullish until we're not. There's the warning signs are out there, but we got to continue to take it day by day, especially in these long summer trading days that we have. So
yeah, was it Dogs of Summer or something, or I don't
the
know.
dog days of summer are upon
That's it.
us.
Yes.
They are.
But I
Oh.
refuse to bark to respond to that comment. All right. Okay, well, have a great week, and thanks for tuning in, all of you folks, and spread the word because I think
All
we're
right.
doing some good analysis here. Thank you.
Absolutely. Thank you all. And thanks, Mr. Weissman Cooper, and everybody else listening in. You guys have a great one. We'll catch you next Thursday, but I'll see you tomorrow on the Lunch Money Show with Chris Pulver. All right. See you guys. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.